Good morning. Thank you for joining Mayer Brown's Global Financial Markets Teleconference Series. Today's call is entitled, What Changed? Understanding the FDIC's Revisions to the Brokered Deposits Restrictions. My name is Jeff Taft. I'm a partner in Mayer Brown's Financial Services Regulatory and Enforcement Group based in our DC office. First, a couple of housekeeping items. As regular listeners will know, this call is being recorded. We will be emailing an audio link to all participants should you wish to listen to the teleconference again or forward to your colleagues. In addition, the recording will also be available as a podcast on your preferred podcast platform. Since we will not be having a Q&A session, please send your questions regarding today's topic by email to gfm@mayerbrown.com and we will respond promptly. This is the same email address on your invitation. Joining me today is Mayer Brown partner Anna Pinedo and Mayer Brown senior associate Matt Bisanz. Anna is a partner in our New York office and co-leader of the Global Capital Markets practice. She focuses on securities and derivatives and represents issuers, investment banks, financial intermediaries, and investors in financing transactions, including public offerings, private placements of equity and debt securities, as well as structured notes and other hybrid and structured products. Matthew Bisanz is a senior associate in our Financial Services Regulatory and Enforcement practice in D.C. He counsels U.S. and non-U.S. financial services firms on a variety of regulatory and compliance matters, transactions, and investigations. With those brief introductions, let me provide a bit of background around brokered deposits before Matt and Anna discuss some of the substantive aspects of the FDIC's recent rule. Last December, the FDIC finalized revisions to its rule and prior guidance regarding brokered deposits. The revisions had been proposed in 2019 and generally will become effective on April 1st, 2021. However, there is an extended compliance period until January 1, 2022, during which institutions and putative deposit brokers may continue to rely on existing public staff advisory opinions and submit notices that are newly required by the revisions to the rule. This rule is only the latest chapter in the long-running story about the FDIC's regulation of brokered deposits. While brokered deposits may seem like a relatively benign topic, it's been the subject of back-and-forth tussle between the industry and the FDIC for many years, generating several studies, countless FDIC interpretive letters, and even congressional attention. In the FDIC's defense, not that they need me to defend them, advances in technology and online banking have dramatically changed the business of banking since Congress enacted the broker deposit provisions in Section 29 of the Federal Deposit Insurance Act as part of FIRREA in 1989. The intention of Congress was to impose restrictions on brokered deposits and notification obligations on deposit brokers after the savings and loan crisis in the 1980s. This action was based on the regulators' view that brokered deposits were risky because they potentially drove growth and risk-taking by troubled institutions and were volatile in that they would move from one institution to another based upon the rates paid by competing institutions. Several regulatory initiatives were undertaken beginning in the 1980s, targeting to address this risk associated with brokered deposits, and these culminated in the enactment of Section 29 in 1989. Section 29 defines a brokered deposit as simply a deposit accepted through a deposit broker. Thus, the meaning of the term brokered deposit turns upon the definition of deposit broker. If a deposit is accepted through a person who is a deposit broker, the deposit is a brokered deposit. As originally adopted, Section 29 also required deposit brokers to provide notice to the FDIC. This requirement was repealed by Congress in 2000. I mention the repeal because at least once a year someone asks us whether a deposit broker status still requires notice to the FDIC, at which point we say no, that requirement was repealed, and we immediately know that they are either a great historian of the FDIC or just old like me and remember the requirement. To implement Section 29, the FDIC issued a regulation that restricts the use of brokered deposits and limits rates paid on interest-bearing deposits that are solicited by banks that are less than well capitalized under the banking agency's prompt corrective action framework. If an institution is adequately capitalized, it must seek a waiver from the FDIC to accept new brokered deposits, and some institutions may be subject to limits on the rate of interest they pay on brokered deposits. There are also what I would call regulatory externalities associated with brokered deposits. For example, brokered deposits are also subject to less favorable treatment under the deposit insurance regulation and the liquidity coverage ratio. While these externalities do not preclude institutions from accepting brokered deposits, they effectively increase the cost of operation and expenses associated with this activity. Historically, the FDIC has expansively interpreted the scope of the restrictions on brokered deposits by adopting a very broad regulatory definition of deposit broker that was further expanded upon through subsequent fact-specific staff interpretations. For example, affiliates and subsidiaries of a depository institution have been considered deposit brokers, as were employees of a depository institution who are not employed exclusively by that institution, which could affect certain individuals duly employed by a financial institution and its affiliates. Consistent with Section 29, the FDIC has excluded certain persons from the definition of deposit broker. Persons excluded from the definition of deposit broker include those whose primary purpose is not the placement of funds with depository institutions, commonly referred to as the primary purpose exception. While helpful, many of these exceptions proved difficult to interpret or apply over time because of the general changes to the banking of business and the specific changes to the acceptance of deposits. The FDIC's framework for identifying and regulating broker deposits has not changed for many years, although the agency recently amended its regulations to implement a provision of the 2018 regulatory reform legislation that excludes a capped amount of certain reciprocal deposits from treatment as broker deposits. This period of inaction increased the industry's compliance burden. For example, as technology has evolved, many banks have pivoted away from the branch model that made deposit solicitation analysis simple and straightforward. Also, the FDIC released a study on broker deposits in 2011 that was required by the Dodd-Frank Act and published an advance notice of proposed rulemaking on this topic in December of 2018. This is the predicate for the rule that we are going to talk about today. These developments have highlighted the compliance difficulties associated with reviewing contracts and agreements to determine whether brokered deposit status exists. With that, let me turn it over to Anna, who's going to talk about some of the particular revisions within the rule.
Thanks, Jeff. So, as Jeff mentioned, the revisions functionally narrow the definition of deposit broker, and they do that by more clearly defining the term and also by creating more exclusions. So functionally, the revisions replace what's currently a two-part definition of deposit broker with a four-part definition that focuses on the types of business relationships that the broker has with a customer, and we're going to go through some of those. So first off, the revisions focus on whether the person is engaged in the business of facilitating the placement of a customer's deposits with an insured depository institution, and looks at whether the deposit broker is subdividing bank-issued master CDs and selling those modified CDs to brokerage customers. So in this case, this is something that really was already kind of within the scope of the definition of deposit broker. It's not really an expansion of the restrictions. It's intended to capture the brokered certificate of deposit market already. The revisions limit the meaning of engaged in the business, a core part of the definition of deposit broker, to situations in which a person is acting with respect to more than one depository institution and where the person has a business relationship with the depositor on whose behalf the deposit is being placed. So it's important to highlight that these particular changes weren't in the 2019 proposal. They were intended to respond to industry comments, and they more closely bring the changes into line with the intent of Section 29. So the consequence of these particular changes is that persons who are operating deposit placement arrangements, that is, placing deposits only at one insured depository institution, won't be considered deposit brokers, meaning that the deposits that they're placing are not going to be considered brokered deposits. Obviously, very helpful in the case of an affiliate or subsidiary of a depository institution and dual employees who generally are placing deposits only of the affiliated depository institution. Third, the revisions limit the meaning of the phrase engaged in the business of placing deposits to situations in which the person's actually receiving funds belonging to a third party and depositing those funds at more than one depository institution. This change is intended to provide additional clarity on the types of activities that are required in order to be considered a deposit broker. Finally, the revisions more narrowly define facilitation of deposit placement to limit it to circumstances in which the putative broker is taking an active role in opening the account or maintaining a level of influence or control over the account after the account is opened. So this reflects the FDIC's intent to tailor the definition of facilitation to circumstances where the deposits are less stable as a result of the ability of the deposit brokers to control the movement of the deposits among various depository institutions, as well as the FDIC's view that non-business activities and administrative activities should not cause a person to be deemed or to become a deposit broker. So under these revisions, facilitation of deposit placement would occur when the putative broker has the legal authority to close the account or to move the third party's funds from one insured depository institution to another, or is involved in negotiating or setting the rates, the terms, the fees, or the conditions for the deposit account, or in matchmaking activities. This definition is narrower than what was originally in the proposal and reflects the FDIC's determination that certain information sharing administrative activities wouldn't influence the movement of deposits between or among insured depository institutions. As Jeff mentioned in his introduction, historically, the primary purpose exception was pretty narrowly construed and effectively limited to a handful of very specific circumstances articulated in various FDIC staff interpretations. These revisions expand the primary purpose exception to be explicitly available to an agent or a nominee that's engaged in one or more of 14 designated businesses, which is broader than the proposal, which would have extended the primary purpose exception to be available to a person who has assets under administration for customers and places fewer than 25% of total assets under administration for a business line at depository institutions, or places customer funds in transactional accounts at depository institutions to enable transactions or make payments. The 14 businesses are specific and varied, but they largely incorporate concepts from the prior FDIC staff interpretations. Eligibility for designated business exclusions will be assessed on a business line basis. That means that a person may be able to rely on multiple exclusions for different business lines. The FDIC expects that a person will determine their own appropriate business lines in good faith, bearing in mind that a business line usually will consist of the business relationships with a specific group of customers for whom the person places or facilitates the placement of deposits. The FDIC also expects that depository institutions will have awareness of persons involved in the placement of deposits to properly complete call report fields for brokered deposits and will be able to access records related to primary purpose exception that are maintained by such persons. The revisions recognize that other arrangements also may qualify for the primary purpose exception and will allow agents and nominees to apply to use the primary purpose exception on a case-by-case basis. The FDIC also may determine that an approved arrangement should be made generally available to the industry as another arrangement that the FDIC has specifically identified as a designated business. However, the preamble to the revisions explicitly states that the primary purpose exception will not be available if the purpose of the broker's relationship with the customer is to encourage savings, maximize yield, or provide deposit insurance, or has a similar purpose to those examples. Now I'm going to hand off to Matt, who's going to take us through other parts of the revisions.
Thank you, Anna. Under Section 29, well-capitalized institutions are not subject to any interest rate restrictions. However, the statute imposes interest rate restrictions on insured depository institutions that are less than well-capitalized, as defined under the Prompt Corrective Action Framework. Specifically, the statutory interest rate restrictions generally limit a less than well-capitalized institution from offering rates on deposits that significantly exceed rates in its prevailing market. The revisions amend the FDIC's methodology for calculating the national rate cap, and the local rate cap for these purposes. The revisions also provide a new simplified process for institutions that seek to offer a competitive rate when the prevailing rate in an institution's local market area exceeds the national rate cap. Under the revisions, the national rate cap will be the higher of the national rate as based on a weighting of rates by deposits, including credit unions, plus 75 basis points, and 120% of the current yield on similar maturity U.S. Treasury obligations, again, plus 75 basis points. The Treasury-based second prong also provides that for non-maturity deposits, the test will be the federal funds rate plus 75 basis points. Further, the revisions indicate that the local market rate cap will be 90% of the highest offered rate in the institution's local market geographic area. Specifically, a less than well-capitalized institution will be permitted to provide evidence that any bank or credit union with a physical presence in its local market area offers a rate on a particular deposit product in excess of the national rate cap. The local market area may include the state, county, or metropolitan statistical area in which the insured depository institution accepts or solicits deposits. The revisions also eliminate the current two-step process where less than well-capitalized institutions had to request a high rate determination from the FDIC and, if approved, could calculate the prevailing rate within the local markets. Instead, a less than well-capitalized institution may notify the FDIC that it intends to offer a rate that is above the national rate cap and provide evidence that another institution with a physical presence in the less than well-capitalized institution's normal market area is offering a rate on a particular deposit product that exceeds that of the national rate cap. With respect to non-maturity deposits, Section 29 does not explicitly explain how the restriction should be applied. However, the revisions adopt a new interpretation for the solicitation and acceptance of non-maturity deposits that focuses on whether the institution is opening a new account for a customer, accepting deposits in excess of those a customer held at the institution prior to the prompt corrective action downgrade, or increasing the interest rate on the account. Non-maturity deposits would be considered accepted in instances when, after the institution becomes less than well capitalized, a non-maturity brokered deposit account is open, the amount of non-maturity brokered deposits through a particular deposit broker increases the balance above the level prior to the downgrade, or for an agent or nominee account when new funds of a new beneficial owner are added to the account. The preamble to the revisions notes that the FDIC is considering further modifications to its deposit insurance assessment regulations. However, any modifications will be addressed through separate rulemakings at a later date. Turning from the substantive to the procedural, the revisions add a new process that may be used by any insured depository institution or deposit broker to qualify for the primary purpose exception that Anna was talking about. These thus allowing persons who would otherwise be deposit brokers to avoid this classification. Persons relying on the designated business exclusions for having assets under administration for customers and placing less than 25% of those total assets under administration at depository institutions, and the exclusion for placing customer funds in transactional accounts to enable transactions or make payments, must submit a notice to the FDIC or have the institution at which the deposits are placed submit notice. A person also must notify the FDIC if it previously relied on one of these two designated business exclusions, but no longer satisfies the primary purpose exception. The FDIC may request information from such filers, but generally expects to make such requests only if there is a reason to believe that the person does not meet or no longer meets the criteria for the exclusion. Further, an institution or person that relies on the 25% exclusion will need to provide reports, generally quarterly, on its broker deposit activity by submitting the report to the FDIC. A person or institution that invokes the payment facilitator exclusion, in contrast, will need to provide an annual certification to the FDIC indicating that the person continues to place all customer funds at depository institutions into transactional accounts, and that customers do not receive or accrue any interest, fees, or other remuneration from the arrangement. For the 12 other designated business exclusions, no notice is required by the person involved in the placement of deposits or the institution receiving deposits. For arrangements not covered by a designated business exclusion, a person or institution would need to submit an application to qualify for the primary purpose exception. Applications to the FDIC would need to include sufficient information to demonstrate that the primary purpose of the person's particular business line is something other than the placement of funds, and address the relationship's revenue structure, marketing activities, and fee arrangements. While an application may be submitted by an institution, the FDIC expects that most applications will be submitted by persons involved in the placement of deposits. The FDIC also notes that it may impose reporting requirements in connection with approved applications. We expect that a large portion of existing brokered deposits will no longer be characterized as brokered under the revisions for the reasons that Anna noted. These deposits may still be subject to certain reporting requirements, but they would not be subject to the general restrictions on brokered deposits or the less favorable treatment for brokered deposits under the liquidity coverage ratio and deposit insurance assessment calculations. While the FDIC notes that as of June 30th, 2020, only 10 institutions were subject to the direct restrictions on brokered deposits, the revisions are relevant to the more than 1,900 other institutions that are currently reporting some level of brokered deposits. These institutions may be able to reclassify their existing brokered deposits to obtain more favorable treatment under the liquidity coverage ratio or the net stable funding ratio rule once effective, or again, the deposit insurance assessment calculations. These institutions also may need to revise their compliance programs to account for the inactivation of all prior public staff advisory letters on January 1st, 2022, and the creation of the new designated business exclusions in the revisions.
Thanks, Matt. One of the practical points that our audience may want to consider is that the FDIC estimates that there are going to be hundreds of people who are going to be required to make filings to rely on one of the two designated business exclusions that require prior notice or obtain approval for arrangements that are not covered by any one of the exclusions. We would certainly encourage those deposit brokers to consider filing as soon as possible particularly for applications, given that this is a new reporting regime for the FDIC, and agency resources may be constrained as of January 2022 deadline approaches. As discussed, the revisions are a significant step towards rationalizing the FDIC's approach towards regulating broker deposits, given the evolution of technology and the rapidly changing business of banking. The movement away from relying on individual staff guidance in favor of formal agency action is likely to lead to greater consistency and transparency. The existing public interpretations, which are listed at the end of the revisions, will be moved to inactive status. While most of what we have discussed is positive, there remain some problematic elements. Some of the restrictions on the broker deposits are driven by the statutory language in Section 29, such as the limitations on the FDIC's waiver authority, and therefore action from Congress may be necessary to effect full and complete reform of broker deposits. I want to thank our audience for tuning in. I want to thank my colleagues, Anna and Matt, for their participation. Before we end, I want to provide a couple of brief reminders. You will receive an email with a link to the recording of today's call, and the recording will be available as a podcast on your preferred podcast platform. Lastly, as mentioned before, if you have any questions related to today's content, please email them to gfm@mayorbrown.com. Thank you again for your participation, and you may all disconnect now.